State Street Global Markets senior fixed income strategist, actually, John Herrmann, who's standing by. And John, you were with us at last month's report as well. Now, this one, I know you've always been a bit more optimistic about the economy, but this one, do you take it more as an encouraging sign or not?
I would describe it as a little bit on the soft side. We had private payroll. We had private payroll gain of 64,000. The street was looking for 75. We were just a little bit above that. So private payrolls just underperformed a little bit on the margin. The work week was stable. The unemployment rate fortunately was stable. The hourly earnings gain was flat. So you factor in all these kinds of things, and it was just a little bit on the disappointing side. Not as much momentum as we'd like to see going into the fall. Right,
because you had expected a gain of 10,000 jobs. Is that right?
Absolutely. Well, the big miss here was a big hit to, in addition to the census workers down 75 to 78,000. In addition to that, state and local governments also got hit, and that was the big adjustment. We were surprised by that. The government rolled out assistance of $26 billion to state and local government. Was not enough and not timely enough to basically prevent the adjustments at the government level of payrolls. So net, you have to look at the big picture. It's okay that we got a decent result in terms of private payrolls, but we have to look at aggregate payrolls in the economy, aggregate spending power, aggregate earnings power, and we were absolutely on the softer side of consensus on this number.
Okay, and you do see the dollar right now, John, weakening to less than 82 yen. This is for the first time since 1995. So the markets are taking this as a bit of a disappointment, but is this really a definitive report, John, that the Fed is now going to come in?
This is a report that really supports quantitative easing. It supports the second round announced at the November 2nd, November 3rd FOMC meeting. This is highly important. This also introduces risk that the size of the program could be much larger than what people have been thinking about, more forceful. It also suggests that there's this persistent, ongoing need of support from policymakers to keep this recovery going.
We want to bring back John Herrmann. He's the State Street Global Markets senior fixed income strategist. And on that note, John, we were just hearing from Bill Gross, who is saying, look, we are now at a critical point that the Fed has to move. Otherwise, instead of 2-3% growth that we're seeing here in the U.S. economy, we could be seeing much less than that.
Absolutely. Completely would agree with that assessment. What we're seeing here, when we look through the details of the report, what we saw is the following. Number one, as your previous reporter mentioned, flat work week and hours and the wages also flat. That means
average hourly earnings,
Exactly. So that means personal income was basically very, very soft, very flat, soft in the month of September. That's foreshadows spending power going forward, which is inadequate to sustain growth anywhere near 2.5. First point. Second point is that there was a lack of breadth in hiring. We saw the gains highly concentrated in a couple of sectors. Outside of those sectors, there was, again, another month of broad-based weakness in payrolls. This has got to be very troubling to Fed officials and any of those Fed officials
but you see a gain of 130,000 per month, on average, monthly, right? Are you going to be able to get to that forecast with these numbers?
I think this is going to be very, very difficult. What we're seeing businesses do is the following. Businesses are what we'd call operationally very lean and extremely efficient. Businesses have focused their efforts. The profits are extraordinary. They've really focused their efforts on being operationally efficient and lean. So that means that's not exactly consistent with really sustaining good growth in payrolls without additional stimulus on both the fiscal and the monetary policy fronts.
Betty, it's John. Let's not also forget about these first revisions that we're getting that Mike McKee was telling us about earlier, that the economy may have shed another 360,000 jobs than we previously thought. Stocks haven't just been rallying because of the stimulus expectation. We talk about the November elections and the idea potentially of gridlock. A lot of people were wondering what the unemployment rate would look like today and whether or not that would be, the number that depends on how things play out in November. These revisions might factor into that too, and that's going through the sentiment of people who are looking at the stock market right now, whether they should buy.
John and Betty. Let me make a quick point here about that. A lot of people are saying that what may get companies off the fence are the election results. One way or another, there'll be some sort of feeling of which way we're going. So I wonder, as far as the Fed is concerned, whether they're going to wait until November 3rd, the day after the election, and try to read that. John was talking about the fence sitters, but this is a sort of status quo report. It's weak, but it doesn't suggest necessarily a fall back. And I don't know that those fence sitters are going to be convinced that this is such a dire situation that they have to move yet.
Okay, well, we would disagree with that just a little bit. I mean, in terms of near-term growth for the next, for the third quarter and for the fourth quarter, this report is relatively neutral. However, once we cross over into 2011, then we're going to see the Bush tax cuts expire without any further adjustments.
Well, we don't know that yet. We don't know if they're going to expire.
We don't know. But we don't know. But this points to those risks where if you run into next year with basically inadequate job growth, and you're also, there's sunsetting of the Bush tax cut. This points to very substandard, very weak growth in the economy. So what officials need to do is say to themselves, number one, we need to extend the Bush tax cuts over the course of 2011, 2012.
All
we need
across
to
the
provide
board.
clarity across the board. We need to provide clarity to businesses, to households, to everyone on this factor. First thing, and then I think we continue to need a more forceful response from Fed officials in terms of QE2.
Well, yeah, but what Stiglitz is arguing for is that then that's going to raise maybe this argument that we need another fiscal stimulus, that the Fed action is not going to be enough.
Well, if we do not extend the tax cuts, I mean, then we're obviously going to need some additional stimulus. And I don't think we want to get caught in that give and take, because we saw in the second quarter, for example, that we had the census worker hiring, which was a net add to the economy. But at the same time, we also had unemployment benefits expire on over 2 million people, which was a big net drag on the economy in the second quarter. We don't want to keep doing these things.
But then they got renewed, right?
And then they got renewed, and then you can see. And you can see that consumption came back as soon as they renewed it. So we don't want to be constantly taking away and then giving back. We want to basically, we want to have a well-defined formula here.
John Herrmann, I want to bring you back for some final thoughts. Do you think that the Fed looks at this jobs report, looks at what's going on in the bond markets and says, I want to see the 10-year down to a 2% yield?
I would think that would be very smart thinking on behalf of the Fed. We need a target. This sounds a little bit off, a little bit extreme, but we need a target of about 2% in the 10-year yield. We need to set off a refi wave. We need to supplement households' budgets with lower carrying costs for the homes. We need to bolster consumer spending power.
But why 2%? What's up with that number in terms of triggering the refinancings? Real quickly.
I think what we find when we look at what's called the mortgage stack, what we can see is that there's about well over $500 billion of mortgages that are on the cusp. These are high quality mortgages that are on the cusp of refinancing. We lower 10-year rates another 40 basis points. That would trigger that refi wave.
Okay. All right, John. Good to have you with us.